Hi, I'm Sue Harding, and today I'm going to be speaking with you on the topic of climate accounting and audit. First, I would like to thank the organizers of the event for inviting me to present on this topic. It's one that I believe is critically important for the financial system as well as the climate we all live in, and it complements many other topics being presented. First, a few contextual references. I work as a member of what's called the CAP team. This stands for Climate Accounting and Audit Project. CAP is an investor-focused project to promote incorporation of material climate risks and decarbonization efforts into company financial statements and their audit. I'm also a long-term member of CRUF, which is the Corporate Reporting Users Forum, and that's a global network of investors and analysts engaged in debates about accounting, governance, and regulatory issues. In May, CRUF produced a briefing on climate accounting and audit, and this followed an earlier CRUF blog posted in early 2023 that summarized a range of thoughts on climate accounting, aiming to insist investors and analysts address the topic with companies. The blog included insights on the relevance of climate risk to financial statement reporting under IFRS requirements and debunked some of the myths around applying those requirements. In 2024, the CRUF briefing builds on this, highlighting aspects of accounting and audit that investors may want to raise as concerns over the course of 2024, raising them with companies, auditors, and regulators that oversee both of those. And it focuses on IFRS again. While the briefing doesn't directly address US accounting and audit requirements, many of the concerns will also be relevant for those in the US. The focus of the work is on reporting. Specifically, it addresses financial statement reporting produced by the company and the auditor's published report. Other reporting of information on climate may be relevant in considering the financial statements and the audit, but it's not directly the topic of this discussion. In terms of why it matters, I think what we're really seeing here is that climate risk is business and financial risk. It seems to be increasingly accepted as such, but it can also be financial statement risk. So if it's a risk to the investors, it's a risk to creditors, and it's a risk to the market, essentially. And the range of physical and transition risks, together with the company's own steps to mitigate, may drive changes across the business model and present different financial and business risks. A company's climate-related risks and strategy, its steps towards a low-carbon economy can also represent financial statement risk. And that is the risk that the financial statements are materially misstated. For example, its profits and or assets are overstated, or its liabilities understated. Misstatement can also result where disclosures that are necessary to understand the financial statements may have been missed out. Some climate-related business and financial risks represent incremental costs to the business. Others may drive early replacement of productive assets, particularly carbon-intensive assets, and such changes can raise financial statement risk. So thinking about the assets and the liabilities on the balance sheet, that's really the focus of where this risk may lie in number terms. Significant asset values may exist where the risk of misstatement is overstatement. These might be carbon-intensive property, plant, and equipment balances, reserves of fossil fuels or other commodities that are dependent on carbon-intensive economy. Depreciation and amortization expense may need to increase for reduced remaining lives of these assets, production estimates for the asset, or lower residual values at the end of life production. Impairment losses may result if recoverable values decrease for shorter periods of operation, lower sales volumes, sales prices, margins, higher costs, etc. Goodwill and other indefinite-lived intangibles, investment in joint ventures and associates may suffer similar impairment risks of write-down. and deferred taxes may be written down if recovery is impacted by expectations of profits that are diminished. For significant liability values, there the risk is a risk of understatement of their values. And this may relate to provisions, for example, relating to asset retirement obligations, sometimes referred to as AROs, or dismantling or decommissioning obligations. They may increase when the timing of expected future costs is brought forward by estimates of earlier retirement of assets or previously off-balance sheet contingent liabilities are recognized as the timing of settlement. Therefore, the present value of the obligations can be estimated. And some contracts may become loss-producing, onerous contracts that require recognition of liabilities. So the climate issue is a financial issue and a financial statement issue. It's financial and financial statement that happens to relate to climate. So what are the IFRS requirements? The IASB has confirmed its standards are sufficient to address climate risk, suggesting that the problem lies in application of the standards. Now, following an earlier publication in 2019, in 2020, the IFRS Foundation published education materials on the effects of climate-related matters on financial statements. These materials made clear that climate risk is to be considered just as any other risk, and companies must consider climate-related matters in applying IFRS when the effect of those matters, reading a quote here, is material in the context of the financial statements taken as a whole. Information is material if omitting, misstating, or obscuring could reasonably be expected to influence the decision of the users, the investors. This highlights the relevant requirements, including overall, the education material highlights relevant requirements by accounting standard, essentially, including overall disclosure requirements under IAS 1 that should result in companies making sufficient disclosure so that their financial statements can be understood in relation to how climate was considered, adding disclosure of additional material information if it is necessary to achieve the objective. In March 2023, the IASB commenced work on its project titled Climate-Related and Other Uncertainties in the Financial Statements. In July, it republished its education material, sort of emphasizing its continued relevance. In April 2024, an agenda decision was produced by the Interpretations Committee to demonstrate how IAS 37 would be applied to emissions reduction commitments, including application of relatively challenging criteria that would need to be met before a provision or a liability is booked. And additionally, at the end of July 2024, the IASB will publish an exposure draft of several illustrative examples relating to disclosure of climate in the financial statements. None of these steps changes the requirements. They are intended to support application of the existing standards. As for the international audit requirements, the situation is very similar. In 2020, the IAASB staff published an audit practice alert. This also confirmed that while climate is not mentioned in the ISAs, climate-related risk is to be considered just as any other risk in assessing the risk of material misstatement of the financial statements, so the numbers being wrong or the disclosure being inadequate. And there are three areas of the auditor's report that we think are most likely to provide transparency on how climate risk was considered in the audit. Now, these are the key audit matters, the most important, the matters that in the auditor's judgment were the most significant in the audit of the financial statements of the current period. The assessment of audit risk, so how they dealt with the risk of climate presenting a material risk of misstatement to the financial statements, and their consideration of other information in the annual report. This is sometimes referred to as the consistency check, where they read the rest of the information in the annual report outside of the financial statements for consistency with those financial statements. So the requirements are clear, and the standard setters have set about confirming and sort of helping with application. In spite of these requirements, however, there is remarkably little said about climate risk in most accounts and most audit reports. Evidence from Carbon Tracker in their series of Flying Blind reports shows that the financial statements produced even by the most climate-exposed companies in the world, as well as the audit reports, continue to miss out on providing meaningful information. The most recent study was of 140 of the most climate-exposed companies globally, and they found essentially that only 40% of reports provided any meaningful disclosure on such matters. They also found that 63% of the financial statements and 80% of the audit reports were assessed as having provided no substantive disclosure. So the accounts and audit reports for a majority of even the most highly exposed companies are missing out on disclosure of what investors believe to be meaningful information or material information in accounting speak. This has to, over time, be increasingly presenting a risk of compliance and regulatory risks, ultimately legal risks. So the absence of the disclosure will not be without consequences. Risks are growing in that sense. So Cruff in this paper has really just proposed two areas where progress may be made, and that is treating reporting as more as a communication tool. Perhaps over the last decade, there's been a focus on cutting clutter, i.e. removing immaterial information, but there needs to be a reemphasis of including material information, in this case on climate. Considering the material information to be disclosed is a critical element of any principle-based system of reporting, and anecdotal discussions suggest that some companies and auditors don't realize how poorly their reports are communicating information that is desperately needed by investors on climate to be making their decisions, their buy, hold, sell, their voting, their engagement decisions relative to investee companies. The second area that's proposed is that regulators really need to begin enforcing in a strict manner. Even with modest improvements that we expect to see from Carbon Tracker's assessment of 2023 reports, changes seem unlikely to be sufficient to meet the requirements in the near term without such further intervention. Some regulators are making progress on this, FRC in the UK, ESMA in Europe. Those two in particular have been very active in this area. But the need for information on climate risk in the financial statements has become ever more pressing as year-on-year materiality is only increasing. More information is available on risk at company level. More companies are committing to emissions reductions goals, such as achieving net zero, and investors participating in the CA 100 Plus initiative and beyond continue to emphasize the need for such information. However, it's not being met, and this does need some regulatory intervention. Thank you for your interest in this topic, and I'd be happy to receive any comments, suggestions, or questions. Thank you very much.